Welcome back to the Income Machine. Today, we are going to be taking a look at Vertiv and using that to run a wheel strategy and see if we can't make a good income off of about a $55,000 portfolio. But before we get going, smash that like button, subscribe if you've been with us a while and haven't done so yet. Check out the Trade Cave store, link in the description as well as the channel bio. Check out our great products there and let's get into it. So Vertiv. Vertiv is a company that I've talked about on the channel before. They do immersion cooling for data centers, which is particularly important for Bitcoin mining as well as HPC data centers, which is AI data centers. This has been getting a lot of institutional attention lately because the new NVIDIA chips require immersion cooling, no more air cooling for the AI data centers, and those are becoming pretty big. So that is why Vertiv is absolutely rocketing off here and has been for quite a while, as you can see from the chart here, honestly, since whew, how since when? Since April 2023, this thing has been on a heater, and we just recently got a pullback that we've broken out of. All right, so that's why I'm looking at Vertiv. We broke out of a pullback, and we are on our way up now. Now, arguably, I should have started doing this a couple of weeks ago or a few months ago, but that's beside the point. We're getting into it now. We're going to start looking at it. Now, I'm doing this slightly differently than with MicroStrategy and NVIDIA. With Vertiv, I don't actually have enough free cash in order to do a cash secured put on Vertiv. So for this one, I am using a paper trading account in order to get into it and track it as if I were actually doing the trade. So on this one, I'm not actually making this money. This is a paper account for Vertiv simply because I don't have enough money lying around to do another one of these. I've already got MicroStrategy and NVIDIA going. I've got the Bitcoin miners going. I've got Palantir going. I don't have enough money to do this one as well. So this one's going to be a paper trade specifically just for the exercise only. All right. So just being upfront with that right away. So with Vertiv, what did I sell on it? So this is the contract I sold here. This is the image of the contract I sold here in my paper account on Webull. You can see that I'm already 20% down on that account on that buy. I did that at well, one disadvantage to doing the paper account on Webull is you have to do a market order. You can try to do a limit order on the paper account, but it does not work ever. It almost never works. I've never gotten it to actually do a limit order, only the market order. So this was a market order, and so it obviously gives you the worst price possible at that time. And then price continued to fall into after hours after I went ahead and sold this put in my paper account. So I sold it for $545 out to October 25th, so about a month out at a $92 strike, which means I would need $9,200 in order to do this put. And I would have received $545 for selling out a 1 month put off of this for $9,200. And let's see, what would that end up being in terms of a return? If I get the whole return, we're looking at about a 6% return in a year, or 5.92% in a month. Sorry, not a year, a month, which aggregated out to a year when it ended up being 71%. So you get 71% of your money over the course of a year for $9,200 times 5.71. You're looking at $6,532 per contract per year if you can maintain this sort of dynamic as we have with this first month here. Now, how would we make that into a bigger, better account? How are we going? How much money are we going to need in order to make a salary out of this? So let's just go with, let's say, a $40,000 salary, right, in a year, and we've got 6,532 per year off a contract. So that would be about 6.12. So we're going to go with 6. So you're going to get a little less than $40,000 on this thing um, per year. But let's see, because obviously you can't do 0.12 of a contract, 9,200, and you're looking at about $56,000 to do that. Or if you got rid of that 0.2, it'd be about $55,000. You would need to run this wheel for a year and collect about $40,000 of income off of that. Okay, so that is all very interesting and good. Oh, let me get rid of that stuff. Actually, I don't know why. I don't know where that came from. How to get rid of that. So anyways, that is what we're looking at here. And we're already down 650. So if I would have waited for a more strategic entry, like something closer to the end of the day, we go to like the 30-minute chart, something closer to the end of the day, I could have gotten a higher price on that. But that's okay. So why did we pick 92? Let's go ahead and look in here and analyze what we're doing here. Why did we pick 92? Yes, you see at the end of the day here, it came all the way down to the 21 and bounced. That's actually a really good bounce right there. That actually makes me pretty confident right now, at least in the short term, that we might be able to close this out for a profit within a couple of days. By maybe even Wednesday or Thursday of next week, I might be closing this out for 20 or 30%. Anyways, why did we pick 92? Well, 92 is coming back to this support back here. Let me draw some lines around it. So 92 is coming into this support back here, right there, from just yesterday, right? And we have been following the 21 EMA all the way up on the half hour chart. And if we go to the hourly, show you how that looks on the hourly. We've been following the 21 EMA up on the hourly for a couple of days now. Honestly, since we went below it just a little bit here on September 16th, and we've been bouncing off of it and riding along the 21 EMA for a while. The 21 EMA is currently at $92.75, so I gave it a little bit of room to come down a bit. Plus, I have that $545 of cushion, meaning it could come down past 92 by $5.45 before there would be threat of a potential early execution if that was something that was on the table to happen, right? Early execution is rare, but it can happen. And if it's not profitable to do so, then you're pretty much safe from it happening. So we would be able to go, about $5.45 under that. So it'd be about 86.60 before you're really at threat. So 86.60 is all the way down. It's below this big chunk of support right here. So I'm really not too concerned. And even if it gets down here and it looks like the contract is going to close down here on this $86, $87 level, I could roll it out. And to do that, I would just buy to close that sold put and then sell another one at a lower strike further into the future, like I've been doing with MicroStrategy, like I have done with NVIDIA, and that's how we would handle that. Okay, so let's take a little bit of a look at Vertiv overall. So Vertiv overall, I like it simply because it is that immersion cooling that is a requirement for new data centers, especially those running HPC AI data center servers. So that's why I like this. Right now, the thing I don't like about this right now is it's got a 69.2 PE ratio when the industry average is something like 40-ish. So they are significantly overvalued at the time. Now their forward PE is actually where things get a little nicer. Let me see if it shows it here. Does it show the forward PE on here? No. The forward PE, let me look it up on Webull real quick. The forward PE is actually 37, which falls right back into average. The price to book right now is 23, which is significantly higher than the 3 average. Price to sales is only 5, so not too bad. So the expectation is that this company will grow into its valuation and probably maintain somewhere between a 40 to 70 PE ratio going forward. So I'm not super duper concerned about it short term now. Like maybe 2, 3 years from now, I might be concerned about them, and I don't know if I would continue to hold it or play this type of strategy on Vertiv after the data centers have gotten themselves tooled up for immersion cooling. They're probably going to be holding on to those units for 4 or 5 years. We don't know what the churn is like, and it might end up like a Cisco play in the dot-com bubble where everyone thought Cisco was going to the moon, and it did for a short period of time. But then once all of the all of the telecommunications companies had built out their infrastructure, well, then it cratered, and that's what I would expect from this company as well. Once the data centers have built out their infrastructure, this will crater, along with its competitors. And I think that's also probably likely to happen with companies that do like superconductors and other things related to power and electricity. Once they're built out, they will crater for several years until it's time to re-up that infrastructure once more. So this is an infrastructure play. It will at some point, once the infrastructure is in place, it will crater. And I don't think that time is yet, and I'll tell you why I don't think that time is yet in a moment. First, let's take a look at their fair price. So right now it's trading at $92. Fair value is being estimated by Simply Wall Street at $144. So we could run this thing all the way up into the low 100s, low to mid 100s before I would stop running this type of strategy on Vertiv. Okay, so once it starts getting around 120, 130, I might start thinking about maybe I don't want to do that, or maybe anymore, or maybe I would let it get executed in terms of the put and then start selling covered calls on it. We'll see how I'm going to play that in the paper account, of course, in the paper account. Okay, yeah, see their price to earnings ratio versus their peers. So the average is about 31, and they're trading at a 69. But that is, and we'll go down further to ownership. And if we go down to, that's because of the owners. So we've got BlackRock coming in at 9.1%, Vanguard at 8.97%, JP Morgan at 3.7%, Invesco at 2.27%, and State Street at 1.95%. And if you notice, all of those have been adding. Look, BlackRock added has been increasing by 24% recently, Vanguard by 0.07%. That's barely anything, but it's something. JP Morgan has increased its position by 600% in recent days. You can see Invesco increased by 12%, State Street by 2.79%. Now let me go on to the Sage Tracker. You're not going to see this, but I'll tell you how it looks on the Sage Tracker in terms of where these companies purchased this at. And you're going to be a little bit surprised to feel like we're late to the game, but I'm going to go ahead and say that I don't think we are, since they are still adding to this position. So BlackRock is in at that 9% range, and 9.1% for their average cost is $42.97. Vanguard, their average price is $19.47. JP Morgan, their average price, and this is why they're adding so much, because they're trying to lower that, or why they were adding so much. They probably haven't been since it's been in the high 80s and low 90s, but their average price is $78.24. So they either really believe in this thing, or they really bought in heavy when it went to that dip on that leg down that we were looking at here from that this descending channel. Someday it will load. In this descending channel here, that's probably where they were picking it up as it was coming down, 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 and they were trying to catch up on that. Let's take a look here. Invesco is in at $22. State Street is in at $24. So they're all in at very, very low prices, but they are still buying in recent days. So they're still thinking that there's some room to grow on this thing a bit more. And I mean, fair value was above the all-time high, which is over here at, is this the all-time high? Recent high, anyways, over here at 109. And it's saying they could go significantly higher than that, like 30, 35% higher than that. Let's see what that would actually be. See if my mental math is any good. 44, 144, 32%. Yep, about 30% higher than that, which would be an increase 30% higher than that, which is currently what? Just currently about 16 higher than percent higher than we currently are. So something like 40, 45, 50% higher than where we currently are is where we could potentially go. And that's not right. That math is bad. Learn how to do math, dude. Uh, sorry. It would be, let me just do it with this thing so I don't have to make stupid claims. About 53%. Okay, about 53% is where it could go from here currently, based on the fair value projection by Simply Wall Street. Okay, so those are the reasons I'm interested in this thing. And I am looking at it to potentially maybe even come down as far as 190 and test the 5-day moving average on the daily chart. And that's kind of where I'm expecting it to hold. I'm expecting it to hold on the 5-day, if not on the hourly 21 EMA, which is the blue line on my chart you'll see here in a moment when it comes up. That's what I'm kind of expecting right now. I'm expecting to do that and ride up into the upper fib bands on this thing here, and not on the hourly, but on the daily. I'm expecting it to ride into the upper fib bands. But I'm expecting it to hold this. Maybe, yeah, see, that's at 192.76. And the 5-day was all the way down at 190, which would be support on the hourly down here. It could come, yeah, like 191, 190s support on these two wicks here. It could come down as low as like 89 or so, but that's okay. I would just roll if that were the case. Anyways, that is the income machine for now. This is a new ticker that we're covering on the income machine. I don't know why it's doing that. Ah, there it is. The income machine, we've so far in our paper account collected $545 on this particular ticker. We are currently down 20% on that. We'll see. I might decide to roll it right away next week on Monday if it goes another 20% down on me, just because that way I could collect a little more premium out of it, and that would be all right with me. And I would lower the price to like 89.90, maybe push it out a week or two and try to squeeze out another 100 or two in premium out of it. We'll see if I decide to do that or not, but that's what we're tracking right now. Watch for soon. I'll be doing an update on the income machine for MicroStrategy and NVIDIA. There's not always something interesting going on with those, so I'm trying to do an income machine at least once a week. So it'll be kind of this format on everything other than MicroStrategy and NVIDIA. Those ones are real. Those ones I'm making real money with, and those ones are pretty exciting. But there's not always something happening in there, so I'm trying to do more of this kind of income machine I really like. running the wheel strategy, and I would like to practice it more, even if it is just on paper, because I do think that this is how I'm going to make money going forward, especially once I'm done with the Bitcoin miner trade for this cycle. I'm going to be doing a lot of income generation versus any other type of trading here in that account. So anyways, that's all I've got for you today. Please like, comment, subscribe, share this video. Check out the Trade Cave store, link in the description, as well as the channel bio, and have a profitable day.